All right, welcome back, everybody. Hopefully, everyone had a wonderful weekend, enjoyed your holiday as well. Chris here. We are back, ready to rock and roll with another webinar. We're doing this one on Tuesday, naturally, as yesterday was Memorial Day. But today we are going to be covering the wonderful topic of risk management in practice. This is an extremely crucial subject. So if you're here for this one, pretty excited for you. This is a often overlooked yet extremely important aspect of trading. It's often referred that this alone is one of the big differences between a profitable trader and an unprofitable trader. We're going to start off, as always, by jumping in with some market disclaimers, as always, as we're required to. After that, we're going to get on into the good stuff. The first one, I'm going to read for you, nice and easy, so you can sit back, drink your coffee, enjoy your lunch, whatever it is you're doing. And then I will leave the next few there up on the screen for a short while so you can read through them yourself or screenshot them and save them for later. But without further ado, folks, let's get on our way. Getting ourselves started off here, everyone. Let's rock and roll. Earn to Trade is provided to you for educational purposes only. Earn to Trade is not a financial services company. Earn to Trade does not accept any liability for loss or damage as a result of reliance on the information contained herein. This includes educational material, price quotes, and charts and analysis. Please be aware of the risks associated with trading the financial markets. Never invest more money than you can risk losing. The risks involved in trading are high and may not be suitable for all investors. Earn to Trade doesn't retain responsibility for any trading losses you might face as a result of using the data shown on the website or webinars. The data and quotes contained may not be provided by exchanges, but rather by market makers. So prices may be different from exchange prices and may not be accurate to real-time trading prices. Any examples used are not a recommendation to buy or sell, or a solicitation to buy or sell futures, options, bonds, or binaries or securities of any kind. The information and strategies and techniques discussed herein are the property of Earn to Trade LLC. They may not be shared or distributed to another party without the express written consent of Earn to Trade LLC. Any trademarks or copyrights referenced other than Earn to Trade are the property of the respective holders and not Earn to Trade LLC. Alrighty, folks, moving on to the next one, which I will let you read or screenshot on your own, either or, whatever you prefer. Leaving the Forex disclaimer on the screen for just a short while. Please take a look at it, read through it. Alrighty, moving on to our next disclaimer. Getting through this together, as always. Keeping the momentum going on to our next one. And finally, brings us to our last disclaimer. Take a moment to read through or screenshot, save for later, and we will be on our way. Okay. So first off, welcome back, everyone. Normally we're doing these on Monday, but like I said, yesterday was Memorial Day, and I do hope everybody had a wonderful 3-day holiday. If you did have one, and if you didn't, well, then I'm sorry. Don't know what else to say about that one. However, we are back, so we've got something to be happy about, something to celebrate. Today, we're going to be covering the topic of risk management in practice. My name is Chris. I am a mentor and trader here at Earn to Trade. I do operate all of these webinars as well as do the daily recaps and the educational material as well. Do some mentoring and all of that good stuff. So many of you already know me, but if it's your first time joining me today, then hello, nice to meet you. I do try to keep things just a little bit about myself. I do try to keep things as casual and comfortable as possible. I feel that the more comfortable you are, uh, the more these topics will soak in at a bit of a more efficient pace, I suppose, is the way I'm trying to word that. If you have any questions as we go along, I would like you to just ask them. Ask them freely. Type them in the chat box at the time that you think of them so you don't forget them. I may not answer the question immediately. I will go back though and read through every single question. If I don't answer it immediately, it's possible that I am planning on addressing that topic or answering that topic um, at some point during the session, and as a result, I know you're going to get that answer, or I might already just be in the flow with one thing, and I'd like to keep that flow going and then come back to your question a little bit later. But don't take me not answering your question immediately as a sign that I'm annoyed or anything like that. That's not the case. Let's have a good time, folks. Let's keep it casual. Let's have some fun. And I do feel that's the most conducive environment to learning in general is when we just keep it relaxed, nice and easy. Today we're going to be talking about an extremely important subject, risk management. Risk management is one of those topics that you kind of hear about anytime you start reading anything about trading. There's always generally something about risk management. It is a crucial subject, very often a little bit more overlooked than it should be, because risk management is often referred to as the difference between a profitable trader and an unprofitable trader. Um, the idea behind risk management is it's what controls the ability for us to be profitable, despite, even if our risk management is correct, that is, we can lose more trades than we're actually winning and still be profitable with proper risk management. Yes, you can lose more trades, statistically speaking. I could lose 3 trades and win every 4th trade and still be profitable with correct risk management, as long as I am risking a low amount and looking to gain a high amount, etc. We'll get a little bit more into that. But right now, we're going to switch on over to my charts, which at the moment are focused in on the E-mini S&P 500, otherwise known as the ES for short. So let's go ahead and do that now. Here we are. So once again, taking a look at the S, we'll be using this chart as well as probably swapping around to some others. And if you have a favorite of your own, you can feel free to recommend it as we're going along. I don't mind switching to that either. But this will be our base chart for the moment, and we will be using it for our base of operations here. So, getting ourselves started off into the wild world of risk management. First off, what is risk management? We're going to start at the very basics and we're going to work our way through. So, risk management is nothing more than simply controlling the amount of risk that we're choosing to expose ourselves to in order to gain some type of reward during every single position that we're executing. Okay? So, risk management is how much we're choosing to risk, quite simply, in order to gain the reward that we're seeking. Now, with the proper controlling of risk management, as we're going to talk about, yes, it is possible to make sure that we're always in a situation where we're looking to gain more than we're looking to lose. Meaning we have a positive risk to reward ratio. And with a positive risk to reward ratio, we can allow ourselves to be in a situation where we have more swings at bat, so to speak. We have more attempts, we have more trading attempts available to us, with a lower accuracy rate expected in order to attain that profit that we're looking to achieve. Now, before we get too deep into risk management in and of itself, It is extremely important to understand risk management is one of those things where you're going to have to find your own feng shui. You're going to have to find your own flow. You're going to have to find what fits for you personally. It's a very personal matter. Nobody can tell you how much is the right amount that you should be trading with. And as such, nobody can tell you how much is the right amount you stand to be risking. Now, when we start talking about percentages of account, you're going to start hearing some numbers, and then it becomes a little bit easier for you to generalize where you feel comfortable and what, more or less where you should probably be. But because everybody's financial situation is different, effectively, everyone's risk management practices should also be different. Somebody that has access to a $100,000 trading account most likely is going to be risking a monetary value that is higher than somebody that only has access to a $5,000 trading account, correct? So for that reason, a lot of the things that we're going to discuss today are going to be more or less concepts and ideas. There's a lot of different math topics that get involved with risk trading, a lot of different strategies to calculate, probability of gain versus your probability of loss, and in order to help identify where you should calculate, how much of your account you should be risking per position. There's a lot of different things. Risk management is a massively large topic, and as such, what I thought would be a great idea today would be to simply cover the generalized concepts, so we can pretty much cover everything without getting too clustered down by some of the more intricate ideas. Because once you understand the concepts from there, it's going to be quite a lot easier for you to venture forward and understand those concepts yourself, should you, so choose, which hopefully you will. Just starting right out of the gate. So if we're looking at the ES, we're looking at a pair where effectively it's one contract is going to represent $50 per tick, correct? So if we're in a situation here, or I'm sorry, folks. We might want to switch over to I'm thinking I might want to switch over to Forex to begin with, and then work back towards what I'm going to go over here with the ES. Actually, let's do that. Let's switch on over to Forex first, folks. So taking a look at Forex, there's a reason behind that. We'll switch back to the ES here thereafter. I just actually jumped ahead on one of my points while I was bringing in our intro there. So I do apologize. But starting off with Forex, guys, one of the most widely traded assets in the market, and one of the widely traded Forex pairs on the market, we have ourselves the euro dollar. Now, basic risk management in practice is simply, like I was saying earlier, controlling the amount of risk we have exposed for every position, right? So we want to have a calculated plan before we go in. So for example, if I'm looking at the euro dollar, which I am right now, so if I'm looking at the euro dollar right now, and I notice that we had a swing low somewhere around this 1.150, right, near the bottom of this move in general, I'll mark it off with a nice little white line right here. So right near that 1.1510, we had a beautiful swing low. Theoretically speaking, we're just going to go on examples here just so we can keep moving along. Say we identified that this was a very strong area of support. Now, on the current charts, it only represents a swing low and really not a whole lot of anything more, which is visible to you guys. But if we paid attention to this 1.15 low, and say we had a bunch of other hits over here, we continued to come down toward this 1.151 and just kept bouncing off of it. We had a lot of tests around this location, and we just noticed support, and once again we came down. And as we're witnessing what the market is doing right now, bears are pretty strongly in control, and the market does seem to be diving after running into a little bit of resistance up here near that 1.1590, and we do appear to be heading back down to test this 1.151 now as we speak. So we've got ourselves a live situation where, in theory, once again, we're not actually looking to buy here. We're going to use this as an example. But hypothetically, if Trader John, so to speak, or if myself, if we were looking to place a position on this trade, and we identified with the fact that we want to buy because we're expecting a transition here, we're looking for some type of test off of the support, and once we see that test, we're looking to ride the market upwards. In trading, we make money based on a correct forecast of which way the market is moving. We make money based on how far the market moves in that direction. So if I say I'm going to go long at 1.1510, I'm looking to buy at 1.150, obviously I'm looking to make money based on the market going upward. The farther the market goes upwards, the more I stand to gain. If I'm wrong and the market goes downwards from that 1.151, if I've got my limit order set there, and the market goes down, say it falls down to the 1.150, we're in a situation where unfortunately the market's going against and losing money at that point, right? Just like everything, everything's a yin and a yang. With trading, obviously we can stand to gain or we can stand to lose, as with all investments. So if I want to get in and I decide that I'm looking to control my risk to a point where I want to say, okay, how can I risk no more than, say, 5% of my account on this one position? Now, the percentage is going to be something that you're going to have to decide on your own. Some traders advocate risking no more than 1% of their account on any one position. And by risking no more of 1% of your account on any one position, this would allow you to obviously sustain 100 losses before you completely wipe an account. 100 losses consecutively, that is, of course. So 100 losses consecutively would wipe an account if you're risking no more than 1%. If we're risking 5% position, obviously it's going to be a little bit different. We're going to be looking to risk somewhere around 5. I'm sorry, somewhere around 5. Goodness gracious. At 5% of our account, we're going to have 20 losses consecutively that we can sustain before we wipe our account. So the amount that you risk is going to be completely dependent on your personal financial situation and what you feel comfortable doing. At the end of the day, comfort is going to be king. It's going to be the driving factor on how well any of your strategies succeed. If you feel comfortable with what you're doing, you're naturally going to be finding more success with it, and as such, you're probably on the right track. But in today's example right now with the euro dollar, we'll say that we're looking to risk somewhere around. So we'll say we'll stick it to the 5% rule. So we don't want to risk any more than 5% on any one position. So let's say 5% for us. 5% for us represents a 10 pip decline based on the margin that we're using, based on the leverage that we're using in this particular situation. Once again, the amount that you're trading is going to be dependent on what asset you're trading. Obviously, everything is different. Okay, if we're trading the ES, the value is going to be different. We're going to be looking at $50. We're going to be looking at $50 a point on the ES, whereas per one contract. Whereas with the euro dollar, it's going to be dependent on the leverage that we're utilizing in order to determine exactly how much the value of each pip represents for us personally. So if I go ahead and figure out that at 1.1510, I'm looking to jump into this position for my long, and somewhere around, let's say, somewhere around 1.1500, okay, 1.1500, somewhere around 10 pips lower, where that will represent about a 5% loss, or exactly a 5% loss for my particular position. When I look to get in for my buy, when I look to get in for my 1.1510 long, which is at the present level, let's switch this to green so we understand. Once again, we're looking to rise here. If I'm looking to get in at the 1.1510 for my long, for my buy, looking to ride the market upwards, then simply speaking, if I set my stop loss, which is the command, obviously you guys know this. If you don't, it's just simply the command to close my position out and limit my losses, so to speak. If I set it to 1.1500, and that represents, once again, a 5% loss, so to speak, for my account, and that's what I've predetermined for myself. And once again, this is all going to be completely dependent on your situation, your financial situation, and what you feel comfortable with. Okay, but generally speaking, somewhere between that 1 to is honestly as high as 10%. You'll see traders risking anywhere from 1% to 10% per position, 10% being on the very high side, with most traders advocating between 1 and 3%, it being more on the conservative side, but it seems to be a little bit more common in today's day and age. However, as high as 5% is also still very common for a single trader, or I mean for a single position, in terms of any of your intraday traders and scalpers, anything away from the institutionalized trading. But so taking a look at this position in general, guys, I'm telling the market to buy and open my position at that 1.1510 where the green line is presently marked. If the market rises and goes upwards, obviously I want to have all of this calculated out ahead of time. So we know exactly before we even enter the trade, before the market even reaches down here, while we've been talking about this, we have plenty of time. Before the market even reaches our position, before it's even filled, before this long even opens, we already know exactly where we're going to close the position if things go south. We've already decided that we're not going to risk any more than 10 pips on this particular position. Now, this is where it gets fun. We're talking about the risk. Talking about risk is never as much fun as talking about reward, because we're talking about a situation should it go south. And despite it not being as fun to talk about, it is crucial. We got to be prepared for all options. We need to be prepared for all options if we want to intelligently move forward. We're not going to win every trade. If we did, then we wouldn't need stop losses. That'd be wonderful, but that's not the case. So we've dictated that we're not going to risk more than 5%. And that happens to be 10 pips in this particular position. And once again, this is just strictly speaking a pure example. All right, these obviously the number of pips that 5% is going to represent is going to be different for every single person. So, anywho, we've got a 1.15 10 pip decrease as our stop loss set down here. If the market reaches 1.150 when we're in for a buy, expecting the market to go up, we're going to close our position out and we're going to accept our loss. Now, our take profit, once again, we're also setting this before the trade opens as well, or as we're placing all of these, or as we're placing this position, we're setting our stop loss and take profit at the same time as our entry location. So if we recognize that a 10 pip decrease is what a 10 pip loss is what we're willing to accept as our stop loss, realistically, we should be looking to gain that much or more. Now, you're very rarely going to hear traders advocate a 1-to-1 take profit to stop loss ratio. So when I say that much or more, that much would represent 1-to-1. That means if I'm in for my buy here, my take profit goal would be set at 10 pips higher, which would be the 1.1520. So that would be right up here. So I'll give us a second green line. We'll use a blue line as our take goal, actually. Separate all these colors here. So that means right here would be the blue line would be our take profit goal. So we're looking to enter price at the green line at the 1.150, and as price reaches that 1.152, we're looking to exit price. That means effectively we have risked 10 pips should things go south for the potential to make 10 pips should things go in our direction. If we're risking 10 pips to make 10 pips, this is 1-to-1. Now, what happens, though, if we set our take profit goal a little higher? What happens if instead of at the 1.1520, we set it at the 1.1530 here? Now, all of a sudden, if we're looking for price to go all the way up here to get out, all right, we're giving ourselves a 2-to-1 risk to reward. That means we're risking 10 pips should things go south to potentially make 20 pips. Okay, so we're risking 10 pips to make 20 pips, right? So that means if the position goes south and we don't win it, all right, we've lost 10 pips. If the position goes in our favor and we do hit our take profit goal, then we've made 20. So we have 2-to-1. That means for every one position loss, that means for every one position gained, it is double how much we would stand to lose should we lose the position. Okay, so you're starting to see, hopefully, how we stand control that risk to reward ratio in order to control exactly how much or what our accuracy rate needs to be when we're executing the positions in order to maintain profitability. If one loss is only half as much as we gain when we win one trade, okay, then we don't need to maintain exactly, or if we do maintain, for example, if we do maintain a 50% win rate, if we win one trade and we lose one trade, and we win one trade and we lose one trade, we will actually still be coming out profitable, theoretically, because one win and one loss are not equal. We're no longer doing that 1-to-1. Now we're doing 2-to-1. Okay, so by winning one trade and losing one trade, we're going forward. We're coming out ahead, which means and that's at a 50% win rate. Okay, but it gets more exciting. What happens? What happens if we take that blue line? What happens if we take that blue line and we move it all the way up to the 1.154? Jump it up again. Now, say our goal, we're looking for the market to come down, and we want the market to rise all the way up to the 1.154 up here, and we're going to use that as our exit location. All of a sudden, our risk is still the same. We're still risking 10 pips, which, as we were discussing, represents no more than 5% of our account in this particular position. We're risking more than 5% of our account on this particular trade, and we stand to gain 15% of our account. Why is it 15? Because it is 3 times greater than how much we're looking to lose. So at this ratio, once again, you guys can already see that if we're only risking 10 pips, but we stand to gain 30 pips, how many trades we can lose while still winning a position. And I'm sorry, how many we can lose. I don't know why I'm stumbling on my words. I do apologize, guys, just an aside. But if we lose one position and we win one position, and we lose one position and we win one position, if we're coming out at a 50% rate, we are still massively working our way forward. Why? Because each win is worth 30 pips to our account, whereas each loss is worth only 10. So if each loss represents a 5% deduction from our account, but each win represents a 15% gain to our account, we can do a whole lot worse than 50% and still come out profitable, right? With that 3-to-1. And obviously this keeps scaling forward, folks. This is just very simple concepts. I just need to start in the beginning and work our way through it. So if we're looking at the market and we've got ourselves a situation where we now understand that we can control our risk to reward by simply identifying positions, we can by identifying exactly how much we want to risk before we enter the position, then we stand to control exactly what our accuracy rate must be and give ourselves a bit of an edge before we even get started. I believe there was a quote somewhere by Sun Tzu that said battles are won before they're started. Just essentially, battles are won, trades are won before they're placed. Trades are won and lost before they're placed, just simply based on that risk management. It's the strategy that determines the profit at the end of the day. That's why risk management is so important. Some traders argue that even with a complete deficit or lack of skill, but with proper risk management, it is actually possible to still maintain profitability. And we've seen traders pull off different goals and what should I say? Just more or less different contests. We've seen trading tests exist out there where traders have said, okay, I'm going to maintain a 30% win rate or less, maybe a 25% win rate, but I'm still going to gain on my account. And they do this as a demonstration to show the importance of risk management. But that these types of things are possible, obviously. With simple math, you can decide exactly what it is you need to, what numbers you need to maintain in order to maintain in terms of accuracy, what your percentage numbers need to be, how accurate you need to be in order to maintain a profitable level if all of your trades theoretically are risking 5%. And if you're doing it at a 3-to-1, if you decide that you're always going to have a 3-to-1 risk to reward ratio, then you are in a situation where you always know what you're going to do. Now, here's the problem that does lie in with that. Every position, okay, there's nothing wrong, so to speak, with determining that you're not going to allow yourself to ever take a position where you're risking less than 3-to-1. So you want 3-to-1 risk to reward, right? You want 3-to-1 risk to reward. You want to stand to make 3 times what you stand to lose per position. You can decide ahead of time that you're only going to take positions, and that's all well and great. But what we need to understand is, okay, based on how much the market is moving, is going to determine, based on how much active volatility we have, the volume in the market right now. All of these things are factors that we have to consider. Even the asset that in which we're trading, we need to consider what the current state of affairs are in the market before we execute a position to have a realistic goal. And the reason why I'm saying this is say we were trading the euro dollar right now. Currently, the present time is 1:34, just after lunch here, Eastern time. So we're looking at the market and we say, okay, well, we've actually got a decent amount of volatility, but clearly not as much volatility as the earlier morning hours. During closer towards our cash open and everything along those lines, during the more active hours just before lunch. Say 9 a.m. is going to be a lot more active, a lot more volatile, and generally going to see a lot larger swings than you're going to see at 1:30 after lunch. Because of this, we want to be realistic with our goals. If I'm looking to, if I get accustomed to the fact where, say 5% happens to be 10 pips around my account, and I want to look to gain 30 pips, but the market isn't actively moving enough for those 30 pips to be realistic, we might want to consider scaling those goals back a bit. We can still maintain a 3-to-1 ratio, but we might not actually want to be dabbling with such large numbers because it might not be realistic for the market, just because we're being optimistic. It's more important to be realistic than optimistic when we're trading. We might want to pay attention to the market. If it looks like it's taking the market hours to traverse the distance of 30 pips, we might want to be a little bit scaled back. Maybe we want to look for something like 10 pips and risk something more along the lines of, say, 3 pips or 3.5 pips or what have you. Obviously, we can scale it backwards a little bit and scalp the market based on what the market is providing. At the end of the day, the market is the deciding factor in what we're doing. The market, we're not moving the market per se directly, obviously. We can't control how active the market is by ourselves. And as a result, we just simply need to pay attention to it. Just like if we were sailing out in the ocean, we respond, and we were in our sailboat, we respond to the conditions and we drive the boat, we sail the boat according to how those conditions are presently. So the same thing must always be remembered when we're trading the market. If we're trading the market and we understand that the market is currently, taking a very long time to move a set amount of pips or a set amount of points, well, then we should be realistic of we always want to be realistic of what we actually could achieve. It's wonderful to say, okay, we're going to set a goal of, I could simply come into the market and say, I'm going to use a 10-to-1 risk to reward ratio. I'm only going to risk 10 pips, but I want to stand to make 100. But if the market isn't very alive, that's not a very realistic goal. And to be honest, we might end up in a situation where we're more likely to lose that position because it's just so unlikely for the market to move as far as it is at the present time because of the lack of the volatility. So the summary of essentially what I'm saying here is it is very important to be realistic with these goals and be aware of this while we're adhering to our risk management principles. Percentages, for example, like we were already discussing, 5% risk on our account, these things can also be scaled up and down to slow market conditions as well. But during these slow market conditions, okay, we might not be in a situation where we can actually even get to that 5% risk, for example. It depends on our account, obviously. But we might be in a situation where we might not want to be risking that 5% because the distance might just be too far, or perhaps we need to open more lots, or we want to open more contracts in order to get there. But we always want to be aware of the active market conditions when the distance is required to achieve these moves. So, moving forward, we've discussed how setting a take profit goal and a stop loss goal is a very easy way to, on every single position, if we do this, we can guarantee that all of our positions will be exactly 3-to-1 risk to reward, or 2-to-1 risk to reward, or 4-to-1, whatever it is that you decide, whatever it is that you feel that you're going for. Now, the thing is, there are certain positions where, obviously, once again, going back to active market conditions, where we might want to adjust back. Maybe 3-to-1 is going to put the distance required for this particular trade just a bit beyond an area of resistance. Let's take a look at this line right here. I'm going to set an orange line. Let's say because of the support that we previously had, this 1.1535, say because of the support that was shown here. Once again, this is a stretch because we did fall through it. But say there's a very heavy level of support that had a lot of activity in the past around this location. And we do prefer to go for those 3-to-1 ratios. We might adjust our position. Or our risk to reward for this particular position. If we don't want to adjust the numbers, we might adjust our position to say 2-to-1. We might say, let's look for an exit here at the 1.153 instead of the 1.154 and jump out with the 20 pips, because it's a lot more realistic that this position is going to reach and close at the 1.153 than it is at the 1.154. So we're making a calculated decision to temporarily adjust our risk to reward in order to get out at a more likely hit point than what our 3-to-1 would have us do, so to speak, without adjusting all of our other amounts, of course, which we could do. Another very common way to control risk management, when we're placing our positions, is utilizing things like trailing stops. So just aside from the obvious, when we're taking a position like we were already discussing, we can predetermine when we place a position, we can have a stop loss set immediately at the same time that we're placing our position. We can have a stop loss set, we can have a take profit set, and we have an entry location set. Well, another thing that we can do is we can utilize things like a trailing stop. Now, how you're going to access a trailing stop is going to be dependent on which platform you're using, but this is a very common tool that many platforms implement. A trailing stop is nothing more than a stop loss, okay? A stop loss that is going to follow behind your entry after it's been in the profits for most platforms anyway. It's going to follow behind your entry a predetermined amount of pips or points or whatever the measurement is on the asset that you are trading. So if I was in on this position, let's clean this up a little bit. So let's say we got in for a buy, 1.153. So we got in for a buy at the 1.153, and in this situation, we're going to say that we have a stop loss set at the 1.151, and we're going to be setting ourselves a take profit goal, an ultimate take profit goal in this particular situation. We're risking 20 pips, but we're going to look to go, let's go up towards, let's see here. Let's do a stop loss goal. We'll just go up to the 70. We'll just go up to the 70. So I'm sorry, take profit goal. I said stop loss, but so our take profit goal is going to be up here at the 1.1570. We're going to pretend that we're already actively in for our buy. Okay, we're already actively in for our buy right here. Okay, should the market come down to this red line at any point in time, it's going to close our position, and we're going to accept a 20 pip loss, and we're going to say that this represents 5% loss on our account. Should the market rise at any point to the 1.1570, we're going to be walking out of this position, quite obviously. We're going to be walking out of this position with a 40 pip gain, So in this example, this blunt one, we're going to be doing a 2-to-1 risk to reward on this particular position. So we stand to gain twice as much as we stand to lose should things go wrong. But we're looking for this position to rally up towards that 1.1570. Now, I am watching price and say this, once again, we're already in, and we can currently see that price is 1.1538. So we've traveled upwards of 8 pips, a little bit beyond 8 pips since we've entered into our position. So that means we're about 8 pips in the profit. So hooray, we're 8 pips in the profit. Well, if I want to set myself, say, a 10 pip trailing stop instead, okay, instead of the stop loss that I have set down here to guarantee at some point or another, once we reach 10 pips in the money, that is, that a worst case scenario, I would be exiting out of the position break even. Best case scenario, it's going to follow behind price, and if should it draw back at any point, if it draws back 10 pips along its way up to that 1.157, I'm going to be locked out and I'm going to get the profit of whatever that achieved. That means, simply put, let's look at this, we'll use a white line. So if right here, we're at the 1.153, obviously 30 when we're in, 40 is going to represent here, all right, essentially. I'm just using it so it doesn't clog up the ticker box here. But so if this point right here, the distance between our entry point and the location where we're expecting price to go is 10 pips, a trailing stop, the beautiful thing about the trailing stop, what it's going to do is it's going to say, okay, we're constantly going to move your stop loss 10 pips behind the highest point that price has achieved. That means every time price reaches one tick higher, our trailing stop is going to go one tick higher. So if we reach this 10 point mark, or I'm sorry, this 10 pip mark up here near that 1.1540, and then all of a sudden price decides to go, say it benchmarks a new high, and all of a sudden we're up here near, the 1.1550. Well, guess what? If we've gone up in this situation another 10 pips, okay, what we're going to be looking for we're going to watch our trailing stop also move up another 10 pips. And the distance between these 2 points is still going to be 10 pips. It's going to stay behind the highest point achieved after the execution or after the creation of that trailing stop. It's constantly going to trail behind price the exact amount that we have dictated it to. So if we decide that the market is moving up in our favor and the market's not too volatile, so 10 pips should be plenty of room, and we say the market has a lot of momentum right now, so we're putting ourselves in a situation where despite, in case we're wrong, we still do have a trailing stop that is going to be filled to protect our profit, but we're in a situation where we're not allowing the market to ever put us negative. At this point, because theoretically, if the market has already been all the way up to that 1.1550, 10 pips below is still going to be higher than our entry position for the trade itself. So there is no theoretical way, obviously absent of an absurd market swing that moves quicker than market prices, but we're not going to talk about that yet. But in theory, in a perfect world, should the trailing stop work correctly, there is no way that we could ever close this position out negatively. There's no way we would ever close the position out break even. So at this point, we have gotten ourselves involved with a trade where realistically, now it's always important to watch your trades, but in theory, we could just let this guy go without a whole lot of stress behind it. We have a take profit goal set up here so we can let the market keep working its way upwards while knowing, with the comfort of knowing that because of the trailing stop, that this is going to constantly benchmark us higher and higher and higher, and all of the distance between wherever that trailing stop has reached, whatever it has already, gone ahead and benchmarked to, we are locking in, so to speak, profit that can no longer be lost. So the worst that we'll do in this situation, once the market reaches up here, the worst that we're going to be ending up with is a situation where we're gaining the distance beyond 10 pips from where prices moved above what we entered in at, right? So say price works all the way up to, let's redraw this a little bit. So once again, our goal was to get to the 1.1570, all right? And our entry point was down here at the 1.1530. All right. And we set ourselves, all right, and this is what I'm gonna draw with a white line, just so you guys are on the same scenario here. I'm going to draw a theoretical trajectory of price. Okay, so let's just follow the white line here, okay? Okay. So we're watching price, we're working our way up, okay? We're working our way up. And at this point right here, we've gone ahead and executed our 10-point trailing stop. Say right here we did. All right. So at the 1.1550, we said, okay, at this point, we're going to execute a trailing stop, which we're going to use a red line for. So 10 pips below, 10 pips below 1.1550, we're going to be looking to execute trailing stop. So let's go 10 pips below that. All right, we'll say it's right here. All right. Okay. So what this is going to do for us is it's going to, once again, continuously trail behind price. Well, let's say price did what we are showing it did with our white line, and it almost reached our take profit goal, which we had set as well, but then it plummeted, okay? It plummeted, all right? It bounced up, and it plummeted all the way down. At which point, this is going to be a bit of a trick question, so follow along carefully. At which point do you think this trailing stop would have been been triggered if it was executed over here, okay? If it was executed or placed over here, okay, once the market was right here, okay, the distance between these two is 10 points, where would it actually be though? Okay, initially you might be saying, well, it's going to be out of that line. Well, no. Once again, if price worked its way all the way up here, just went straight up, it's actually going to be, okay, the trailing stop is actually going to be 10 pips below the highest point achieved, remember? So it's actually going to be, so say this is like the 1.1568 or something, 1.1568. Well, then we're going to be at the 1.1558, correct? We're going to be 10 points right below that. So let's say that's right up here. I'm just eyeballing this, guys. So the distance between here and here, okay, is what we want, and obviously should it go down, this is going to be what's lost. But remember, if our gain, if we were in at the 1.153, we're in over here, the distance between here and here is very clearly going to be profit. We were in a situation where with that trailing stop, we no longer, despite not being able to reach our 1.157, we didn't lose out on this move entirely because we had a trailing stop to lock in the gains. So we didn't, despite not being correct with our expectation of price working its way all the way up here, okay, despite price not reaching this 1.1570, we were still able to walk out of this position somewhere near that 1.156 with about a 30 pip gain, just because of the trailing stop, which we implemented to lock in the gains that we had already achieved continuously. It allows the to keep moving forward without closing it out, with the possibility to go higher without the possibility for it to ever essentially go lower from the point of the creation. That's another beautiful option with trailing stops. Now, there's a lot of different ways that risk management can be applied. We can look at pairs. So say I'm trading the euro dollar, and I like a position here and it's correlated. One thing that we need to understand is, or correlated, say the pound dollar, for example, the cable, which it is. So if we're looking at the euro dollar and we're looking at a position to go long, but I'm not entirely too certain about that position in general, a lot of times the euro dollar and the pound dollar go in the same direction. It is actually possible, not all the time obviously, but it is possible to hedge our trade, to hedge our bet by looking at a correlated pair, a strongly correlated pair, and we could do opposites, so to speak. And in that situation, obviously, it might be a little bit redundant should they both go the same direction, because we're going to have one win and one loss, but we can cover ourselves with the expectation of a long on the euro and a short on the pound dollar. That is hedging our bets. That is covering ourselves. Should one go one way or the other, we're covered one way or the other. There's a lot of different ways to do that, which we'll cover on in future sessions as well. But it's the concept of risk management that I would like to get into, okay? It's the concept that I'd like to get into, and that's just the idea that we want to be the captain of our ships. We don't want to be controlled by the market. We want to control what we are doing with the market. In essence, while we can't directly control the market, we can control what we are doing with the market, all right? So if we're going to do things like calculating our stop loss and take profits by using something like like an expected rate of return, which would be, say the probability of gain times the take profit percent gain plus the probability of loss times the stop loss percent of loss, we can end up with these numbers. We can reach these numbers, but it's going to be a personal decision at the end of the day, how much of your account you're willing to risk. And remember, just think of it this way. Our risk, think of it as how many trades could you lose in a row before you wipe your account. That number, whatever number it is that you are comfortable with, is going to be your max risk. So if you decide that you are okay with potentially wiping your account after after 5 trades, okay, well, then you're in a situation where maybe you're going to be risking 20% of your account on any one position, which is very, very high. But hey, again, it's a personal decision. A lot of traders say, I'm not going to go above 1% of their account. They're not going to risk 1% of their, not going to risk losing more than 1% of their account on any one position, which means they can lose 100 trades in a row before they wipe their account, right? At the end of the day, it's going to be a personal decision that you have to decide. Now, we also want to remember, like I was already discussing, the current state of affairs. We don't want to trade blindly and say, okay, it's always going to be 30 pips I'm going for, and I'm always going to be risking 10. Because it isn't going to be that way. Sometimes the market is more active, sometimes it's more volatile, and sometimes 30 pips is passed in a matter of seconds, and sometimes 30 pips is passed in a matter of hours. We want to be aware, we want to be more realistic than optimistic when taking these trades. We want to be aware of how much the market is currently moving when placing these take profit and stop loss levels in order to control our risk management in general. Okay, so the idea of risk management, if I could sum it up all in one short little brief snippet, is we want to always be in control of how much we are going to risk before we execute the position. Now, this means bluntly, if we decide we are not going to risk more than 5% per position, regardless of how much or what the market is doing at that point in time, we're not going to risk any more than 5% of that position. That means we have to have the self-control when we get into that position to not keep moving our stop loss lower. We don't want to have that FOMO. We don't want to have the fear of missing out. We don't want to constantly keep moving the stop loss lower because we expect the trade to come back. No, there will always be more trades. There will not be more trades if we wipe our account. If we wipe our account and we're out of money, we cannot trade. Okay, so it is very, very important to have the self-control to decide before we get in how much we're standing to risk, how much we're standing to lose, and how much we hope to gain. By doing this, we'll be exerting some type of control over the market in and of itself, and this is the first step to becoming a profitable trader. Controlling risks, controlling reward, giving ourselves a base, and then from here, we can decide exactly how accurate we need to be with our positions, and we can move forward. But it all begins with proper risk management. Hopefully, guys, this has been a little bit eye-opening or just help you realize a little bit about the importance of risk management in and of itself. Risk management it's a topic, guys, that we could talk about for hours and hours and hours. Today, I really wanted to cover the concept of risk management while showing you guys a couple ways that we can, control risk management by setting stop losses, by setting trailing stops. There are numerous ways to control, to set stop losses, trailing stops, take profits. There are numerous strategies out there that we can implement in order to better control our risk management. But it's the idea that is the most important. It's the concept of understanding why risk management is important that I wanted to cover today. I wanted to stress the idea of what risk management is and why it's necessary to become a profitable trader. Without risk management, we don't really have a control, and it's very hard to go backwards and measure our how we're actually doing, and it gives us a very shaky spot instead of giving us a solid ground to go forward with. If we don't know what percentage we need to maintain in order to be profitable traders, we're kind of just shooting in the dark. We don't really know what the hell we're doing, and we're just in a very anomalous, ambiguous zone, and it's not going to be good for us. It is not. At the end of the day, once we can say, okay, we can crunch all the numbers and we can say, this is how much we're going to risk. This is where my account's at. These are some goals that I have. This is what I'm going to achieve. But I am no longer, the most important thing, guys, the most important thing with risk management as well, something else that I should add in here. It is very good to allow ourselves say, hey, I hope to achieve this or I hope to achieve that. But we do not, okay, setting take profit goals and everything else, they are important. Say we're looking to gain 5% today, or we're looking to gain 10% on the week, or we're looking to gain 5% on whatever it is. It is very important to understand that just because we have not reached that goal doesn't mean, or we don't want to allow ourselves having that goal to allow us to push outside of our risk management. Risk management is number one. We don't want to risk more then we have already decided, just because we're not at our goal. Say we wanted to get to 10% and we're only at 8%, we do not want to push it for a trade that is less than satisfactory just because we're taking a stab in the dark. At that point, we have now become gamblers. And once again, we are now losing some of our control. We do not want to lose our control. We are captains, we are the pilots, and we want to act like it. Remember that, folks. But other than that, folks, it has been a pleasure as always. Thank you for joining me for another beautiful webinar. I do hope everyone had a wonderful weekend and continues to have a great trading week. I will be back, obviously, with the daily recaps as well, so you can hear my wonderful voice as we go forward. If you have any questions as we go on, definitely feel free to contact us, possibly schedule a mentoring session, wait for the next webinar, whatever it is. We're here to help you guys. I know sometimes I make things more confusing than they need to be, and sometimes my public speaking skills suffer at times when I stumble on my words, and I do apologize. But I am trying to exercise one point, and that is the importance of risk management. And hopefully you guys got that today. But thank you very much for joining me, everyone, for an introduction into risk management in practice. Thank you, thank you, thank you. I will see you all very soon. But in the meantime, guys, keep killing the markets. Stay controlled. You are the pilots. You are the captains of your own ship. You got to act like it, and you will succeed. Keep in check, guys. See you all very soon, guys. Over and out.